Good afternoon, everyone. Thank you very much. So we're quite happy to partner with the four organizations and host this space. I think this conversation is also coming at a very timely place in terms of where we are with the geopolitics, with the climate discourse and climate finance, and at a time when most of our African governments are obviously facing huge sort of debt overhang, and the risk that we may not actually achieve our development agenda and may be distracted also and forced to sort of choose like a very forced choice between climate action and development. But I think it's important for African countries to really focus and like eyes on the ball in terms of the more long-term aspects of development, because I think climate for Africa is a development issue. If we don't solve the development question, we'll never solve the climate question. And of course, this agenda is very core to the issue of accessing affordable finance and reducing the cost of borrowing. Anyway, there are better experts at this, so I'll not speak more about that. I just want to welcome everybody. And of course, OSF is also part of this ecosystem of actors that are really interested, not just supporting partners, but also lending their voice wherever it's useful to pushing the various reform agenda for changing the financial system. So I think a key objective of this conversation tonight is really explore further, advance the discussion, and come up with a clear roadmap in terms of effecting and implementing this credit rating ecosystem with African institutions. I would like to acknowledge once again the tireless efforts of the four organizations, and also Ambassador, thank you very much for really showing like your strong commitment to this agenda by being here today, but also by what UNECA does to support this process. Thank you for the participation. There's so many events this week, and you could have been anywhere, and I'm sure there's some other great, exciting topics, but you chose to be here with us this afternoon. Because part of the reason we're starting late is because as OSF, we delayed you because we actually kept him in a meeting. So I think we're going to give you back some of that time at the end, maybe an extra 25 minutes if we need to.
You didn't say you should have told us at the beginning.
Yeah, now I'm saying this. So without further ado, it's my pleasure to really call upon Ambassador Katete to really give his opening remarks.
I was wondering whether I should read a speech or whether I should just have a conversation, but well, since the speech was written for me, I have no choice but just to read it. Thank you so much, all of you, ladies and gentlemen. It's a pleasure joining you today for this timely and important conversation on developing a credit rating ecosystem in Africa. And here the keyword is the ecosystem. And I thank our hosts, of course, the Africa Peer Review Mechanism, the UNDP, who work together very closely, AfriCatalyst, ACET, and of course, the people who are hosting us here, the Open Society Foundation, for convening this high-level dialogue on the margins of the IMF and World Bank spring meetings. I wish to begin by really, with a question that lies at the heart of our gathering here. And the question is like, why is it that in a continent of 54 countries and a combined GDP of more than $3 trillion US dollars, and some of the most dynamic economies in the world, only two countries, Botswana and Mauritius, hold investment grade rating? What has happened? What has gone wrong? Indeed, the answer, of course, is very frustrating, as it is clear. The current global financial system is simply not working for Africa. Indeed, Africa's development journey has been one of the paradoxes. On the one hand, we have immense promises in our dynamic populations, expanding regional markets, and increasing sectors. On the other hand, many of our economies' vulnerabilities are reduced fiscal space and mounting costs of borrowing in international markets. Yet too often, these ratings have been shaped by limited data, inconsistent criteria, and inadequate engagement with African institutions. For those of you who have been rated, I think this is very, very clear. And the consequences include higher borrowing costs, constrained access to global capital, and fewer infrastructure, health, education, and climate resilience. I don't know whether this one is.
Is there another microphone that's on?
Thank you very much. I was just saying that too often these ratings have been shaped by limited data, inconsistent criteria, and inadequate engagement with African institutions. And the consequences include higher borrowing costs, constrained access to global capital, and fewer resources available for infrastructure, health, education, and climate resilience, among many others. When we note that African countries have paid, on average, 12 to 14% on Eurobonds interest in the last 2 years, compared to the average of 3% for the Euro area or Vietnam, then the need for the African-centered credit rating ecosystem that supports fair, accurate, and forward-looking assessments of Africa's economies cannot be overstated. This is how we can mobilize affordable, long-term, and accessible capital the continent requires for the development agenda, and not the current system that deters foreign direct investment, inflate debt servicing costs, and distort perceptions of risk. To this end, I propose 5 actionable proposals in our quest to establish a credible credit rating ecosystem for our consideration. First, we must establish Africa credit rating ecosystem that reflects Africa's regional realities and complements rather than merely mimic global agencies. This must be an ecosystem that works for Africa, one that is African-led, African-informed, and globally credible. Second, developing a credit rating ecosystem requires that we strengthen data systems. In this regard, national statistical offices, credit bureaus, and regional observatories must be equipped to deliver timely, granular, and context-rich data. Third, we must build robust regulatory framework inspired by international best practices, such as the European model, where rating actions follow a transparent and predictable calendar. Fourth, we need cross-sector collaboration, such as sovereign issuers, investors, regulators, and international partners, all working in harmony. A well-functioning credit rating system must be greater than the sum of its parts. Fifth, and most critically, we must build Africa's domestic capacity. This means empowering African professionals with the technical expertise and institutions needed to lead credit analysis based on Africa's own realities. In this way, African countries will not simply be passive subjects of ratings, but active architects of their own credit narratives. Distinguished delegates, as I conclude, I must reiterate that the ECA is proud to work hand in hand with our partners, the APRM, the UNDP, AfriCatalyst, ACET, and Open Society Foundation, to make this vision a reality. From technical advisory services to policy research, from supporting debt management offices to facilitating global dialogue, we are committed to ensuring Africa's voice shapes the financial architecture of tomorrow. And the timing could not be more strategic. Given South Africa's chairmanship of the G20 and the African Union now seated as a permanent member, we have a unique opportunity to push for reforms that reflect the experiences of our nations. Together, we can build a credible rating ecosystem that is truly fit for current purposes and fit for Africa's future. I thank you very much.
Thank you very much. I have not been introduced. I am Raymond Gilpin. I'm with the Regional Bureau for Africa at UNDP. Let me start by thanking all of you, our distinguished guests, for joining us, particularly those who are joining us online, to this conversation about how do we best curate credit ratings ecosystem that works for Africa's development. I'd also like to start by apologizing for the absence of our boss, Ahuna Ezia Konwa. She had at the last minute to travel for business and she couldn't be here. She sends her best wishes and she's looking forward to the outcome of our conversations today. I do have the speech that was prepared for her, but since she's not here, I could go ahead and just talk a little bit about why this is important. We at UNDP have been thinking about why and how is this issue of credit ratings a development imperative? Why is it so important for Africa's development going forward? We decided that if we don't find ways to make borrowing costs more affordable and the amount of resources African countries receive more equal to the demand for resources on the continent, we at UNDP should just close the books on the Sustainable Development Goals and go home. Because without solving the development financing question, everything else becomes that much more difficult. And so we have over time partnered with UNECA, we have partnered with AfriCatalyst, we've partnered with APRM, with ACET, Africa Center for Economic Transformation. Not because we don't think we could run with the flag alone, but we see this as a task that requires collective action among the most important development institutions on the African continent. And our being here together to co-host this event and thanks also go to the Open Site Foundation for joining this bandwagon, speaks volumes about the importance of this issue. Distinguished guests, recent global financial turmoil has reminded us that whenever you have disruptions to world trading systems, African countries earn less. When they earn less from their exports, their ability to invest in development or service their debts becomes acutely constrained. When you have financial uncertainty that rattles global markets and we see convolutions in the bond markets, the next African country is going to market will pay the price for that. And so these recent things are reminding us that we have to get the pricing right. All the institutions that have partnered here, we recognize that credit ratings alone will not solve the issues. In some countries, credit ratings may not even be the primary cause. But why are we focusing on credit ratings? Because we understand that in a data-scarce environment in which most African countries exist, credit ratings play an outsized role in the pricing of risk and the understanding of risk. So we have to come together and find ways to address this. The Executive Secretary has really, his 5 points are really relevant. I'm not going to repeat them, but suffice to say that we have not just been talking about this. We've actually, working together with AfriCatalyst, APRM, we're actually doing a number of things. Some of the things that he mentioned, building capacity, supporting, creating the ecosystem. And it is our hope that this conversation today will advance this issue a little bit more. And so that we could all together, not us versus the credit ratings agencies, but us with the credit ratings agencies, make this ecosystem more development friendly for Africa and more supportive of Africa's development goals. So thank you so much for joining us, and I really look forward to today's conversations.
Thank you, Raymond. I would like to introduce you again, and my apologies. I think I also got taken by the conversation, but I also understand Ambassador would like to say a few words again.
Yeah, let me just say a few points, and that's why I don't like reading a speech, because the question is really what went wrong. And let me tell you, because I think from long time ago I've been in the system, there are maybe two things. One was the reception of aid that was coming our way. And long time ago when you're in the government, we used to have I would say we're very rich because we are getting aid, which is grant. And then if you wanted a loan, you go to the World Bank, you go to Africa Development Bank, you only go to the concessional window. You don't borrow from anywhere else. And that combination of money was enough. And that's why IMF was the most important. Because once you pass the test of IMF, then you know the donors will come and give you money. And also the financial institutions will give you concessional loans. And I remember that the loans that we used to get, 40 to 43 years, with 10 years grace period, 0.75% interest, it was wonderful. And if you have a problem, you'll go to the Paris Club and they adjust it. And you are okay. So our reserves were okay. We had enough money to intervene in the market. There was no problem. So why worry about anything else? But now, as economies have grown, we've reached a level whereby that concessional window is not enough for all of us. That's number one. Secondly, the aid is declining. And when our needs are greater than what we had before. That's a big problem, meaning that we have to find alternatives. Every country in the world will continue borrowing. You cannot say, I'm going to stop borrowing. No. But eventually you need your own domestic resources together with borrowing, and then you can be able to run any country. But these days, borrowing will be different. It's no longer the concessional window because it's not enough, because our economies have become bigger. So we need to borrow outside the concessional window. But if you have to borrow outside, then you need credibility. And if your credibility is not good, the cost is going to be very high. And that's what we are facing. I know in 2013, I issued a Eurobond. I know what we went through that. And the issue of credit rating, of credibility, was, and at that time when we were trying to do that, that's when we realized that all the capacity that we are developing was to get more money from the aid, was to get money from concessional window, was to know how to maneuver and work with IMF. That's the capacity we had built in the system. We didn't have any other capacity. So when you say credit rating, then you look at your staff in the different departments. You never built a system to do that. And that's why people are not even paying attention, because you go where the money is. So that's what we are doing. But now we have reached a point where you have no other choice. And that's why we even never bothered to build a capital market, because, of the whole system and how the government was getting money. Now the reality has kicked in, where we find, hey, where is the money? It's nowhere. We have debt which is very high, 1.1 trillion, and the payment of the loan is quite significant by any standards. You don't have anything else coming in, and yet you are reducing your own reserves that is supposed to be helping in terms of balance of payments, in terms of helping the banking system get extra resources to cater for the imports and all that. And we are now facing a problem. And that's why we realize that we need to start now building something bigger, which is the credit rating. How do you build it? Together with generating your own domestic resources, because 15.6% of tax to GDP ratio is too low by any standards. And at the same time, you need to get resources because you need to continue developing. How do you do that? You get it from outside. Then you need to build your own capacity. It's like in the banking system where you have the credit reference bureau that's going to say, okay, how credible are you? Even for us, how credible are we? But now we have all the partners here. You're all here. Can we partner together and see how we can give the capacity? How can we create the ecosystem of all the people that are necessary, all the skills that are needed for us to be able to help country by country, so that we can aim, at least in the next 10 years, to have so many countries that have graduated which are investment grade. Because it's not really two of them. By the way, they are also almost losing the investment grade. The recent, I'm sure you saw the recent nurse for the Botswana. It is almost at the knife edge. So if we lose that one, we'll be left with one. Mauritius is also not safe. South Africa was investment grade, then it came down. So now, do we continue like this and we think we are helping? We can talk as much as we want, but I think what is very important is for us to say, how do we get these countries together? How do we come up with a joint plan? How do we go in together and which capacity so that we can build country by country? And then we have a target of how many countries are going to graduate. Otherwise, we'll keep talking in one conference and another. I believe that next year when we come at this time in the spring meetings, we won't be repeating the same thing or what is needed, but maybe to say how much have we done together to support countries and how many countries have improved. You don't necessarily have to reach investment grade, but at least you need to improve every year. And how many countries have we supported? So I just wanted to say this. I don't want us next year to come and repeat ourselves without doing anything about it. Thank you so much.
Thank you very much, Ambassador Clever-Gatete. I guess the panel has begun earlier than we thought. I saw Raymond taking notes, but we will not get into the panel at the moment. Thank you very much. A round of applause to our panel session that gave us a step into the conversation for today. Thank you very much. Xavier Mwamba, the Program Manager, Economic and Climate Prosperity at Open Society Foundations. His Excellency Ambassador Clever-Gatete, the Executive Secretary of United Nations Economic Commission for Africa, and Raymond Gilpin, the Chief Economist at the UNDP Bureau for Africa. Thank you very much, Excellence. Thank you. Yeah, I think we're going to swap places and then yes. Yes, we will now move on to our panel, and I will ask our panelists to join us on stage.
Going to try this in the hope that it works. So first of all, let me start by saying thank you to Ambassador Gatete and Raymond for your early presentations. African economies, we all agree, continue to face significant challenges. And analysis that we've done at ACET shows that a number of them continue to regress on economic transformation. Now, we know that the actions that are taken by global credit rating agencies continue to directly influence sovereign debt costs and affect access to global capital markets. And earlier on, Roberto, you and I were in a room where the Minister of Finance for Morocco said it is really around the perceptions and the power of the perceptions of credit rating agencies and that the impact that it has on the cost of borrowing for Africa. UNDP's research has shown that the combined cost of credit rating issues cost Africa around $75 billion. Now, just to put this in context, that $75 billion could have been used for 80% of Africa's annual infrastructure investment needs. And it could have reduced malaria by almost 90%. And we are sitting in a context where we are all nervous about substantive reductions in grant to health on the continent right now. So as Ambassador Gatete said earlier on, we have a real opportunity to strengthen collaboration between all stakeholders to ensure that we are starting to move in the right direction. We are very fortunate today to have a panel with deep experience and understanding of credit rating agencies. And I'm not going to introduce the panel one by one because it's going to eat into our time. So with your permission, if you go on to the information that was sent, everybody's bio is there. So let me start with you, Susanna. as the only other female on the panel with me. Hint, hint. Okay. You are the Director of Macroeconomics at UNECA. So tell us, why do you think it is important for us to revisit these methods and to adapt to the situations on the ground?
Yeah, no, thank you for this opportunity. So I think it was already to some extent mentioned at the beginning, the reasons and the kind of unfairness of the rating and inequity that, the current situation is causing. So let me maybe summarize, why do we need African Credit Rating Agency in 4 points? So first, competition. So the current sector, is definitely not competitive, which also is one of the reasons behind the perhaps biased ratings against Africa. So the three agencies have dominated for more than 100 years. Transparency. As the new agency comes on board, we expect there will be different ratings, and those different ratings will raise questions. So those questions will also reveal new information. Also, a new agency can be rating new entities that were not previously rated by the existing, and especially in Africa, many countries need rating and not all of them are getting it. Diversity of opinions, because the rating agency will have definitely deeper knowledge on Africa than the current three prevailing in the sectors, who are all located with headquarters in the United States and have very limited presence on African continent. And last but not least, very important is sovereignty. So in today's world, to establish Africa's independence, voice, and sovereignty of its opinions, and those credit rating opinions, impact a lot of decisions. We always think about investors, but also in Europe, for example, central bank and national banks and financial sector take opinions into account when making decisions. So independence from the current system will be important.
Susan, I'd like to push you a bit on that one. So one of the things that we've seen from the work that is being done by UNDP, AfriCatalyst, ACET, etc., is the countries are not ready for credit rating agencies. They don't have the capacity to engage with credit rating agencies. So what assurance do we have that they will engage with the Africa Credit Rating Agency, and what kind of capacity will need to be put in place to ensure that happens?
Yes, so yeah, this is actually the most important aspect also of creating the credit rating agency. There needs to be a methodology, and we know that there is a big discussion about methodologies of the existing three rating agencies, which are not really fully transparent. So countries are often scratching their heads, why this rating or the other. So as the African Credit Rating Agency comes on board, it will also be inevitably, increasing capacity to understand ratings in Africa among African policymakers and analysts. So they will also get more nuanced understanding how to read the statements of the credit rating agencies. There is a lot of information, but it needs to be properly understood and take actions.
Thank you very much. I'd like to come to you, Dr. Mutise. The African Union is taking the lead on the Africa Credit Rating Agency, and the APRM is mandated with making that happen. Could you maybe give us an update on progress, and also tell us what needs to happen for the Africa Credit Rating Agency to be credible?
Thank you very much, Mavis, for taking us through this. And it's my privilege also to be part of this discussion for the first time in DC, where we are discussing the Africa Credit Rating Agency. So when we started this work a few years ago, we didn't have this imagination that we can sit down to talk about an Africa Credit Rating Agency, because it wasn't believable that it would be useful. And the issue of credibility
always used to overshadow that it won't be credible. So I'm glad that given the buy-in that we have managed to get now from our principals in the African Union, we have created this impression that it's possible to have a credible institution which is independently run on competence basis. So that's what we think that is the foundation of this institution being relevant. And like I always say that in financial markets, investors are sifting for where credible information is. So this institution, it's always important in every platform that we get to clear the assumption that an Africa Credit Rating Agency is there to give favorable ratings to Africa, which is a clear misconception. This institution is coming to provide an alternative opinion, diversity of opinions. Because the reason why there is so much scrutiny around the big three rating agency is because, like what our Excellency the ES has articulated, we are focusing on a small ecosystem of foreign currency Eurobonds. Where we need to refocus is the domestic financial market, which I think this institution will be very key stepping stone to both educate the market and create a benchmark on putting all the corporate entities that are not on the radar of the big three, which in our view have a huge potential to pierce through the sovereign ceilings. And investors outside Africa have not been paying attention to those entities, which will create a very big market for the credit rating ecosystem in Africa. And even those investors, institutional investors, when they are considering Africa, they will also be willing to get into the domestic market and look more into the domestic currency investments, which will take out most of the pressure and the scrutiny that we are putting on the big three rating agencies. So that's what I think will be very important as a stepping stone or the target market, which I think is very huge if you look at it in terms of the broader ecosystem of the financing for development in Africa.
Thank you, and I really like what the current figures make. The fact that it will also enable us to get a sense of credit rating beyond the narrow focus. Beyond the narrow focus of the countries that are being rated by the existing three. But I'd like to push you a bit. A number of other regions have also gone down this route, and it hasn't been successful. What is the thing that Africa will bring to the table that will make the Africa Credit Rating Agency the exception to the rule?
Well, having been involved in this process from the beginning, I think we are asked that question very many times. We have had colleagues from the BRICS actually being part of our conversation, and they did raise some questions along that same line. And I think in the European Union also, they did take that route. And we did consult all these platforms before we came to a resolution that we took to the finance ministers on what we thought could work. So if you see the declaration that was adopted in the African Union was very clear that this institution needs to be private sector driven, and it needs to be self-sustainable, and it needs to be credible and independent. So why that is important, it's because if that is not there, which is the key currency that any entity that will succeed in that industry will need to have, then it will not serve the purpose. And also to us, what we think is very important that all this project is not get, which is a unique advantage that we are riding on now, is that all our principals in the African Union support the project. And to us, that's a very important power behind this institution. And they've given the leverage to collaborate with international institutions. And I think it won't be surprising to see us also collaborating with the Big Three on knowledge exchange in the near future, because we are targeting a slightly different market. And in our view, there will be more than enough business for all the rating agencies that would want to get into the African market.
Analytical practices. At S&P, you oversee the analytical practices and global criteria for sovereign ratings. I'd like to start with a slightly challenging question first. Everyone in this room knows that, we have a diversity of countries in Africa. And very often we hear from ministers that rating agencies like to fly in and fly out. And as a result, you really do not understand our continent. And that has an impact on the ratings that you give us. So do you not think it would be better for your analysts to be based on the continent? The same way we know the AFCRA will be based on the continent. We will hold them to account, by the way, if they are all sitting in Addis Ababa and not around the continent. So wouldn't it be better for you to have more staff on the continent?
Yeah. Well, first of all, thank you for the invitation. We really appreciate the opportunity to participate in these events. Not too long ago, there have been many of these events, and we were usually reading the headlines of what was being discussed, and gee, it would have been great to be there and be able to exchange some of the thoughts. And I took note of several of the comments earlier, and I'm happy to address some of those later on. But to your point, look, I think the first point that I would say is that pretty much every institution flies in and out of somewhere, right? So that is an extremely oversimplifying aspect of it. For starters, the IMF doesn't have an office on every single country in the world, and that doesn't really. Everybody seems to be okay with their assessment. Neither does the World Bank, and neither does So we rate 140 sovereigns around the world. I think it will be not the most practical view to have 15 people or whatever number people will deem appropriate on every single country that we rate. What we do have is we have a fair amount of diversity on the people that do that. Right. I mean, we have a team of analysts, one of them sitting in this table, who wasn't flying in and out. He was actually in our office in Johannesburg. We do have an office in the continent, and we have a fair amount of analysts that go across several practices, not just sovereigns or ones. I mean, we look at a broad aspect. And the other point is the way we conduct our meetings. And I think it's not just, we don't just show up with no experience and we spend, 24 hours and go out and read everything else in the newspaper. Usually we spend at a minimum, 3, 4, 5 days, depending on what, by the way, and I think the work that Raymond and UNDP are doing on this part of, I think, operating in the ecosystem that was mentioned before, I think is very important, because a lot of the work we do and the reach we have it goes as far as we. It goes as far as we can, as we can, according to many of the engagements we have with the countries. So, as I said, our meetings are pretty long. We look at we don't just meet with the government. We meet governments, opposition, private sector. As broad as a group of individuals that is presented to us, and many times we also have our own contacts. So we try to do this pretty broadly. In addition to that, when we have our assessments, those assessments are not made by just those 1 or 2 people that went to that trip. It usually is a much broader group of people. On any average committee, you'll have at least 1 to 2 or sometimes 3 decades of experience of people that have gone through the continent, not just one country, but many countries. And also, showing experience not just on Africa, but also on the rest of the emerging and frontier markets that we look at, right? As I said, we rate 140 sovereigns, and only a small portion of those are developed countries. The majority of the countries are emerging markets. I'm the head of the group. I grew up in Argentina, so I lived in the CCC world all my life. So we do have something that when you address it as flying in and out, it really misses all the rest of the investment that we've been doing for decades across the board, doing what we do. We'll just leave it in the middle.
Okay, so. But there is this perception, and I think, perceptions are powerful, as we all agree. But, what would be, if I could move to my next question, which is, in what ways are you trying to engage more constructively and transparently with with policymakers on the continent to ensure that there is a better understanding of your methodology, there's a better understanding of your processes, and building on that, how would you envisage engaging with the AFCRA when it is up and running?
Okay, so a few things there, and maybe, well, the first thing I want to say is that I think perception is very important, but I don't believe that now we're behaving more transparent than before, because I feel we were behaving very transparent before, right? So I think what we are now happily participating is in events like this, that, as I mentioned before, we just weren't included in this. We can just crash your meetings, right? So if they're not happening, so it's super helpful that now I think we have built a much more constructive relation, thinking on, okay, what is it that we need to learn from each other? Because I don't think the word transparency implied that there was opaqueness somewhere. And I don't think that was the case. There was lack of understanding, which is very different starting point on a discussion. And I think now probably we're in a very spot already. Mm-hmm. Regarding on the interaction, I think, again, I was listening to some of the comments before on some of the reasons for regional agency. And look, I think the first thing and I think it's known, maybe not for everybody, is that we always welcome a wide, diverse set of opinions, right? And we have been operating in an extremely diverse environment for decades. There are plenty of domestic rating agencies across most markets that we operate, and we work perfectly fine in all those ecosystems. So we don't have absolutely any concern. And I think as I was hearing before, we're always happy to interact, discuss, get involved in intellectual discussions, sharing of information, as long as, of course, we're regulated, as I would imagine the new agency will be as well. Within the confines of those things, we have no problem at all operating together. But I think it's important that and I think some of the topics were mentioned earlier, it's important that we understand the why well before we design the solution, right? I mean, you don't change the weather by changing the weatherman, right? And I think it's very important to understand that some of the issues that we have highlighted in some of our rating actions, it isn't just by design that they are the investment grade sovereigns that they are. It's a product of a lot of things that have happened over the year. And I think ignoring those things oversimplifies the issue. And the last point I want to make is also, it's important to understand the ecosystem, right? I mean, I think it's also not everything is about what the rating level is. And you're probably going to hear from Tatonga here, who can explain that investors, they do look at rating agencies, but I can guarantee you that investors go in and out of credits because of their own analysis, right? So, the fact that you change marginally, who's telling you that, it doesn't necessarily mean you're always going to get it complete different result. And I think it's important to remember, and I think, make sure that within all this thinking of the global architecture, there's a fair amount of time allocated to changing what didn't work. Let's remember that a lot of the sovereigns in Africa went through HIPC, MDRI, came up with very low levels of debt, and fast forward to today, you have a lot of debt, and not a lot of revenues, and that has to be reflected on credit in the end. So I think these factors, they're not that much debated in a lot of these forums. We are debating a lot of, as I said, how the message is delivered, who delivers it, when it's delivered, but maybe it's important also to address, what the message is and why is that the message.
So, Roberto, I'm tempted to come back to you, but I'm not going to. I'd like to go to Jorge. Jorge, you are the Senior Vice President of the Sovereign Risk Group at Moody's. I would like to ask you the same question I asked Roberto. Could you maybe outline some ways in which Moody is trying to engage more constructively with African countries that you rate, and also what you would envisage as your relationship with the AFCRA going forward?
Yeah, thank you. Thank you very much for the opportunity. Before I came here, some of the organization told me you're going to have a bit of a hostile audience. I only see friends here, so that's a good thing, absolutely. No, first of all, and this is something that Roberto also said before, we definitely welcome engagement. It's a great opportunity for us to be here to explain our position about this. And we do this in a variety of reasons. So participating in these events is one of them. We are here to answer any questions, to answer any of the challenges that frequently come with those questions. On the specifics, I would like to highlight a couple of things on transparency, because when I was here before, just taking notes, I read a couple of things. Well, actually, I heard a couple of things related to transparency and related to unfairness of the actual current system, and that is something that we actually need to address. On the transparency thing, you're not going to be surprised if I say, no, I totally disagree. We are not, whatever is the opposite of transparent. We actually are transparent. Our methodologies are public. Our methodologies follow, if anything, a very simple pattern that can be adapted to the specific of each country. Our methodologies follow, for example, in the case of the sovereigns, the main factors that drive defaults or credit risk. We engage with issuers on a regular basis. We engage with market participants on a regular basis. For example, every time we need to change those methodologies, no methodology is changed without a request for comments before. And we do this on a regular basis. From time to time, we have to adapt and we have to change our methodologies because our methodologies try to reflect credit risk. And therefore, every time we realize that there are other factors that can be more predictive of credit risk or of defaults, we need to incorporate those into our methodologies. Every time we rate an issue for the first time, it's not just that we go to the country and spend 4 or 5 days or 1 week or 1 month or whatever. I don't think that's actually the relevant point. The relevant point is that we need to explain to the issuers and to market participants how we come to those conclusions. Not because we always are going to agree or we don't have to agree, but the key thing here is that we need to make everyone understand the reasons or the factors why we take the actions that we take. And that for us it could be some sort of common ground. Again, not for fully agreements on the outcome, but at least to make sure that everyone is aware of the way we try to use these methodologies from a predictable point of view. And I say predictable actually, because if anything, what we want is to be predictable, is to make everyone be able to replicate what we do. Every time you see a rate in action, issuers or for market participants, we always do what we call what could drive ratings up or what could drive ratings down. We typically highlight the factors that we are monitoring. It could be debt affordability, debt burden. It could be geopolitical risks. So with that piece of information, probably many people could they be able to say what's our next is going to be our next action, positive, negative, or no action, because we try to be predictable, we try to be as transparent as possible. Now, if I may take one extra minute just to address the question about fairness. Again, no one is going to be surprised if I say, no, of course, we treat everyone, we try to be fair. The point is not about that. The point is that we need, beyond perception, we need to make sure that we use the data to see if that perception is justifiable. Very recently, we published some research when we show that in terms of African issuers compared to other issuers outside the region, what we see is that the default rate for African issuers, when we see at the rating of those that default, is not significantly different to any in the other regions. That's one of the key points I would like to highlight. So on average, for example, if our median default is at CAA1 or CCC plus in your scale, we see pretty much the same kind of default happening at the same levels, both in Africa or in other regions. Now, there is a key point here, which is the idea about whether or not it's very much focused on frontier markets. And it's true that what we have seen over the last few years is very much a frontier market experience, a frontier market shock. And the reality is that, of course, in Africa, we have a significant numbers. The majority of our rated issuers in Africa are frontier markets. So it cannot come as a surprise that many of those defaults have been happening in Africa, because precisely it's frontier markets which have been affected the most by inflation, by increases in debt, and as a consequence, by increases in interest payments.
Jorge, Thank you very much. And I hear both you and Roberto talking around the fact that you've always been transparent, you've always been fair, but there is, and I know you pushed back on perception, okay? You are operating on a continent, and this is not a view that is held just by the African continent, it's held by other continents with poor countries. So we've got to appreciate that there is a challenge, and it's excellent that we are all in the room having this conversation, because it is about availability of data. It's also about understanding on our side as countries in terms of how we engage with you. So the conversation is just beginning, but I'd like to push back a bit and say, I hear you on transparency and fairness, but you also have to hear us on perception, because those ratings are having a direct impact on what we are able to do for our children and our economies and our jobs. So just hold on to that thought. I'm going to go here, because otherwise the audience will not forgive me for not coming back to them. So if I can come to you, Tatonge. My brother, you were on that side.
Correct.
And you came back. No, on a more serious note. No, look, I think a lot of this is around how these rating agencies affect, the thinking of lenders such as yourself, as you work in global research at the Bank of America. So for colleagues in the room who don't know much about Bank of America, just give us a very brief overview of what you do. And then I'd like to hear from you how much weight the Bank of America puts behind what the credit rating agencies publish when you're thinking through lending to beloved countries on our beloved continent.
Yeah, thank you very much. Yeah, so I'm Tatonga Rusike, Chief Economist at Bank of America. For my sins, I used to work at S&P for almost a decade as a lead analyst in many of the African countries, and I can remember the ambassador here. He spoke about 2013 Eurobond. I was the analyst for Rwanda, and that 400 million, and that money was targeted towards the construction of the convention center. Part of that, yes. Correct. Yes. Yeah. So over time. So in my approach as an analyst, but also as an African, I could feel you get into engagements, boardrooms, right? You want to hear particular things, they're not coming. So sometimes it's very important to put the right experts in front to communicate the right messages. So perceptions could be because rating agencies came into town, they did not meet the right people for the questions that they were asking. And when a rating change has been done, they're like, oh, but they were in the country. Right, so it's very important when governments engage with rating agencies and put the right people in front. South Africa is very good at putting the right people in front. Well in advance, ask the rating agencies, you are coming, who do you want to meet? They tell you what they want to meet. Oh, by the way, there are also these particular questions areas that are important to meet and engage, and the program gets expanded so that there are there's nothing left, right? So where I see it at Bank of America now is on the investor side. So it's beautiful to have this conversation about ratings. But, ultimately the people that buy the ratings are the bond investors, which is now where I sit. We write research that bond investors use. So ratings are one of the many inputs in choosing to buy Nigeria government bonds, in choosing to buy Rwanda government bonds, Ghana government bonds. They're one but many. So those people on the investor side are very smart people. They are clever folks. And the sad part, I think ratings have been the preserve of smart people, and they've not involved everybody else. So those smart people will not agree with the transparency question because they'll tell the methodology is there. These guys publish rating dates, and those clever investors will know when they are publishing, and they can already try and predict what's going to happen, right? But sometimes, from an investor perspective, ratings can be too slow. Lots of changes happen. By the time they act, it becomes immaterial. So, in the steps towards having an Africa credit rating agency, I think governments are sovereign, right? They can make decisions. You can have what you want, but the big test will be making sure that the institution is credible, which is what my colleague Meshek has been saying. Establish the institution. You can establish it. Make it credible. How do you make it credible? One idea is to have a rating agency in the form of an independent central bank. Central banks are owned by governments, predominantly across the world, but they try and make interest rate decisions without the influence of politicians, because that way you can establish credibility in setting interest rates, and your domestic market can function very well. So in managing costs, it's not just about the dollar bond issuance, but it's also the domestic financial markets. East Africa is very good with low inflation, and therefore perhaps to some extent lower borrowing costs than, say, West Africa, outside of those regional unions where inflation is over 20%. So it becomes more difficult. If you think of 100 cents in a government budget, where 40 cents is used to pay interest cost, most often than not, you'll find that 30 of the 40 cents is going to pay for domestic debt rather than external debt. Some of the external debt is concessional. So it's important to deal with those issues on the domestic side. So we can establish, let it be credible, and let's have investors in this discussion. It's very important because ultimately those are the buyers that are going to buy the bonds that the countries would be issuing in local currency or even for corporates. Because when investors believe that there can be an African rating agency that is going to be credible, they will listen. And you can plug the gaps that the big rating agencies are leaving. Being more agile, having the data. If you are closer to the authorities, you can have the data quickly. Show where developments happening in a positive way. Fitch just upgraded Nigeria to B. They're the first rating agency to see the reforms that Nigeria has been doing in the last 2 years, right? Maybe others will see it later. But where good things are happening, rating agencies can act. And if African credit rating agents can come and show to say, this is what's happening and this is backed by data, investors will believe in it.
Yes.
And I don't want to just leave without saying anything. And it's not only for him, but also for our colleagues here. You know, in school, if you have your whole class almost failing, this year. And next year, they're going to fail again. If you have been marking them for maybe 30 years and they keep failing, how do you feel? You feel bad. And sometimes if they fail, you want to have extra tutorials so that they can be able to be helped. Is there any way that you and the Bank of America can get together, and in addition to doing the rating, you can also support the countries so they can improve? Because on one hand, you also feel bad that the country hasn't moved, okay? On the other hand, the government is there, and the people you went to see, you knew you could see clearly that they had no capacity, okay? You go again, the same thing, nothing has changed, there's no capacity. Is there any way you can combine rating, but also be able to maybe, I don't know if it's guidelines or anything that you can help either you working with the governments, because I wouldn't be motivated if someone is failing this year, I go there again, it fails, I go there again, it fails. I don't think that one is it's not a win-win situation. And you wouldn't feel happy that your efforts were worth it. Whatever, I'm not putting a blame on anyone. I'm just trying to figure out, because anybody is happy to attribute blame to someone else.
Yes.
And this one is not just attributing blame to someone else, but what we all agree is that there is something wrong that we need to fix. And I wouldn't, if I'm party to that, I wouldn't say if it's the problem of the other party. No, it's our problem. How do we fix it? That's what I want to just ask. Thank you.
If I may, I fully agree with you, and I think everybody will agree with you. And I think, I always say, be it this topic or climate or others, we don't just, we live here too, right? So we're part of this. However, I think it's important to find the right solution is to understand the role of each of the players in this game, right? Our role, and that role is not just defined by us, but it's also regulated by entities around the world that they want to ensure that we remain within the boundaries of our role, defines that we cannot come up and say, this is what you have to do to get a better rating. That is a role that is not for us to do, right? We are a third party independent that issue an opinion on the facts that we see. I understand where you're coming from, and there are many entities in this ecosystem that operate whose role is to do precisely what you just described, who understands, as Tatonga was saying, understands very, very well our methodology, understand what we do, how do we do it. A lot of these entities, many, I think the banks have rating advisors. There are many of these entities whose precise role is to do that. It's not the rating agency's role. That it is not that we don't want to do it, is that that's not what we are designed to do.
Ratings should we should do that more. In fact, where you see countries that have rating advisors, they help coordinate better the discussions between the governments and the rating agencies, which I think to some extent, where APRM can also come through, is a lot of education, a lot of capacity building. So banks do that. Perhaps the work needs to be strengthened, and we can do more of that to help governments do better, preparing for those missions, preparing for the engagements, and actually just telling the story. Sometimes perception is important. When good things are happening, blow your own horn. Let the world know there have been reforms, there have been big changes in a country. That helps to drive the right perception. So banks can do and need to continue to do more.
Thank you very much, Ambassador. So we're going to go to the floor, but I'm going to leave one question for you that I'd like you to answer at the end, which is, you said it's not just credit rating agencies you listen to. I'd love to know what else you look at a later date. So I'd like to go to the floor now for questions. Okay, so we have 1, 2, 3. Okay.
Sorry, not you.
Thank you very much. For my sins, first, I was at Standard & Poor's for nearly a decade in the Stone Age, from 79 to 87, and inflicted the sovereign ceiling, among other things. So I apologize for that, but I think it still held up pretty well. Second, I'm a rating advisor. I know Rusoke very well. We've dealt with each other before, and like you are sort of a gamekeeper turned poacher. So as I am, I think that what's missing is what you talked about, Rusoke, which is we don't have here the investors, at least not on the podium. Maybe there are some in the audience, and I commend Vera Songwe, who was able to come up with something that represents what investors can consider. She devised an index for African Eurobonds, which has about half the Eurobond market because of criteria that are allowing you to include or exclude securities. So that's a tradable, potentially tradable index. So I think if it is true that there's bias, there is a free lunch out there. It means that the risk in Africa is lower, according to some perceptions, than is real. Roberto said ain't true because the statistics don't show it. If the investors are smart, as Rusoke says they are, they should say, hey, I want the free lunch. Find me an opportunity to invest in an exchange-traded index-based fund, and I'll buy Africa and I'll sell Latin America and I'll be rich. And the index will then narrow in spreads, and the spread that is based on bias will disappear. So use the market to kill the market spreads. Don't just talk to the rating agencies. Find the investors and have them buy the stuff because there's a free lunch, we think. Now, if they tell us, sorry, there ain't no free lunch, then we go home and tell another story.
Thank you very much. I believe it's the gentleman.
Thank you. Thank you very much for this very insightful discussion. My name is Pierre Gimke. I'm a professor of economics and director of the Africa program at Brookings. And we know that Africa has a very unique socio-economic landscape. 70 to 90% of economic activities are not formal in most countries. And development financing is a huge imperative in some sectors in a way that's different from other regions of the world. So to what extent should an African credit rating ecosystem incorporate local knowledge, informal sector dynamics, and political economic factors that are often missed or overlooked by the global agencies? And then my second question is, His Excellency Ambassador Gatete mentioned the key role of statistical agencies for data availability, which I think are extremely important. But is there a role for AI and alternative data sources, for example, mobile payments, satellite imagery, etc., in creating a more accurate, real-time, and context-specific African credit ratings? Thank you.
Thank you, Pierre. Hanan.
Thank you to all panelists for a great discussion. I feel there is something that has been missing in this discussion that I'd like to bring in, which is the whole focus of what we're talking has been sovereign. However, and that's where I think we need to also bring the value added of the Africa credit rating beyond the sovereign, which is very important. Having African credit ratings that can rate banks, that can rate firms, that can help in developing credit scores of consumers, can help enhance access to finance, reduce domestic cost of borrowing for many of them, and this can become very critical. For not only for banks and lenders, but also for attracting FDI when there is interest. The investor, a kind of assessment coming into a country to invest in, existing companies, it would be different to just come with no track record of any credit ratings versus informed decision. And I can tell you, working with, IFIs, when we were trying to come and work even on things like, SME financing and helping, that type of, existing information mattered. So even if we say, okay, because it takes time for issues of sovereign rating and influence and so on, and it takes, a long time to establish the credibility, there are other critical benefits that this can help. And this is an area where the existing credit rating agencies, this is not their domain. No, they're not going to come to, the country and start to, do credit ratings for, large and small and medium enterprises that exist in Ghana. Okay. So these are areas where we need to focus on more to enhance, reduce the premiums that are charged by domestic banks to lending to these firms. And this can be very helpful. So just to go beyond, the obvious of the credit sovereign, it matters, but there are other things that also are important for these economies. Thank you.
Thank you very much, Hanan. So I'm going to take one more question. So okay, go on. Could you tell me the question online?
How can technological innovation be leveraged? I think that's related to the question earlier. And after, if I will bring more.
More questions? Okay. You have no more at the moment. Excellent. Okay, so I'd like to come back to the panel. And if I may, if I could start with you, Dr. Mutise, the question that Pierre asked around data sources and AI, if I could pass that to you first.
Thank you very much. I think there is no doubt that the areas of access to data and leveraging on AI will be some of key areas where the Africa Rating Agency has to concentrate to develop its competencies, and or maybe let me express it this way: we interact a lot with analysts and colleagues from the big three rating agencies. So we are not enemies at all. We have a lot to learn from them. There are several areas where we have diverse views, but which is very common and clear because we represent different interests. But what has become very clear is that there's a lot of areas that we need not to discredit the big three in terms of the diversity they've brought to accessing capital on the continent. So we still have a lot to collaborate and learn from the knowledge values that they bring. But in terms of the capacities of the Africa Rating Agency, I think Excellency Hannah has really put it through in a clear context that there's a lot of opportunities in Africa that has been lying dormant under the radar that my colleague here pointed out, that it will really stimulate a lot of a demand if investor gets to know the existence of these companies. In the process of what we are working on now, we have identified, like for instance, what comes to mind, there's the Sun Angola, the leading oil or energy company in Angola that has no rating at all. But so we need to also sell the relevance or the importance of having a rating, what impact it will bring to its balance sheet in terms of the real numbers. Companies like the telecoms in Ethiopia with over 65 million subscribers, but with no rating at all. So we look at, from our perspective, the value that African context ratings bring to the whole ecosystem. If there was no value at all, there was no reason why Moody's would have acquired GCR. It means that they see the unique value that the domestic approach will bring in terms of the diversity of opinion and the leverage that it can also use to advance the objective.
Thank you very much. I'm very conscious that I'm standing between people and their lunch. So what I'd like to do is I'd like to go to everybody and whether you want to comment on the gentleman's recommendation or answer a question, but I'd also like you to tell us in 1 minute, how can all of us, what is the one thing we can all do together to ensure we move forward the progress and discussion on credit rating agencies and how Africa can best contribute. So I'm just going to take it starting with you to time.
In 1 minute.
Yes.
I think when banks lend to countries, to corporates, they use a lot of their own internal risk assessments. So ratings are one of them. Markets interpretation through the credit spreads that have been mentioned as well. So sometimes they can differ with what ratings are saying. They also check what are other organizations saying, the likes of IMF. If there is IMF, perhaps investors from our world are happy to say, okay, the particular reform efforts can actually follow through. So that is important. Then with all the discussions around AI, data is very important. If we can get it quicker, let it be known out there. And if there are new positive things, please spread that gospel.
Thank you.
I mean, from where we sit, I think, I personally think we're already advanced from where we were a year before, and hopefully we'll be in a much better place next year. But I think continuing a lot of the work that I mentioned at the beginning that Raymond is doing, in where we interact. I fully agree with what Jorge was saying before. I think our criteria, our methodologies in general, they're out there. They're public. They've been public for many years, and there is a lot of people in this ecosystem that know it very, very well. So I think leverage from that, I think could get us because a lot of the issues that I have observed, they're not so much for because people don't understand it. Sometimes it's just there is lack of knowledge on it, and I think once you go over that step, you're in a much better place. So I think continuing doing some of that, definitely a good way to go forward.
Okay.
I'm going to say that.
Do you want to?
Oh, yeah, sure.
So what I'm going to say is that regardless of whether or not it's the upcoming African rating agency or a big three, we were told. So I think we should take from here that what ratings are and what they are not meant to be. Because ratings, after all, are just opinions from people like Roberto, people like me. But there are other opinions out there in Europe, some other credit rating agencies, in Canada, markets, as it was said before, maybe they also have different opinions. We see market prices and sometimes they differ from ratings. So I think it's good to put all of that in context about what ratings are and what they are not meant to be. And we also need to be careful about some of the regulatory aspects. Now that the ambassador is not here, but the ambassador defined a perfect example of a conflict of interest where we cannot just be doing that. That's not our role. It's not our role to be doing that. Well, our role is to try to do rank order of credit risk. And that's what we do. That's what some of us have been doing for 100 years. And I guess most likely than not, will be for some time now already. Thank you.
So, yes, thank you. So I would have 2 points. So one is simply on building capacity in Africa through new credit rating agency or directly. So there should be dedicated unit in every, government that when the rating agency comes, there is really data is prepared and, the knowledgeable people and the right people are put in front. But I would also say we need to maybe work on, there is a huge problem with debt and the debt restructuring, and actually concern of countries, what will it mean for rating was something that was slowing out the whole process. So I think this time we have to bring credit rating agencies on board and make sure that, for example, proactive restructuring is viewed positively. And in that sense, there is also new debt sustainability needed, because we need to decide when do we need to really restructure.
Thank you. Thank you very much. I was going to summarize, but Dauda has reminded me that he's coming to give a summary of key takeaways. So I'm not going to summarize, but I'm just going to say one thing. In the world of perception and the importance of perception, leave this room with one message. Fitch has upgraded Nigeria to a B+.
Well, thank you very much, Mavis. Please give them a round of applause, please. I am given actually two impossible tasks. The first one is to summarize this very rich discussion, which is almost impossible. But the second one is to keep you actually patient for a few more minutes before lunch, because I know that I am the last one standing between you and lunch. So I'll be very, very quick and very effective. So key takeaways I was asked to do. The first one, before I actually even talked about the key takeaways, is to very much tell you how proud we are at AfriCatalyst to partner with all of these organizations and actually provide this platform today. I think this is something that definitely is much needed. So we thank APRM, we thank ECA, we thank UNDP, ACET, and of course we thank also everyone that has been involved in this event today. So key takeaways. I think the first one that I can note is the fact that it is important, of course, to build a credit rating ecosystem that is first fit for purpose for Africa. I think that was very much said by much of the panelists and, of course, the ambassador before the panel began. And I think it was explained why this matters. It matters for many reasons. Key among those reasons is the need to meet the sustainable development goals by reducing borrowing costs that the African countries are facing. We also discussed about why African Credit Rating Agency was needed. I think APRM made a good case. ECA also made a good case about that. For many reasons that was needed, in their opinion, is that it would provide alternative opinions. It would also, of course, provide for a diversity of opinions. It would also help capture a deeper sort of knowledge of the local context, as well as making sure that we can better incorporate non-sovereign actors in terms of ratings for cooperation and others. And I think it was critical that also, and I think that's very much understood, that such an agency needs to be credible and independent. And I think that was very much talked about. And finally, I think it was also, I think that's APRM that says so, that it was needed that that type of agency collaborate with the big trees in terms of knowledge sharing. I think that would very much be beneficial to that agency. One thing that was very much welcome and that we appreciated was the perspective that we received from the big three representatives. I think the idea that very much they welcome being part of this conversation, and I think having this opportunity to engage with stakeholders, those from Africa, but those that like our organization that are trying to facilitate the discussion. This is well understood, and I'm sure that in a future edition we'll very much be pleased to have you on board as usual, because your perspective was extremely valuable. The idea that, of course, we understood that your approach was very transparent and fair, and that you are taking a step to make sure that you keep account of the local context. I think that was well understood also, and that you're open to operate to collaborate with the African Credit Rating Agency. I think this is something that I'm sure APRM and the African Union will very much welcome, subject, of course, to some condition, including the regulation and others. One last thing that I would say is that credit ratings are important, but I think the discussion also showed that this is not the panacea. We need to also make sure that countries have the right data system. We also need to make sure that they have the right regulatory framework. We also need to make sure that capacities are built in terms of how these officials are engaging with credit rating agencies. I think that was clear. And one thing also that was clear, and that's definitely something that a lot of people do not always think, is to have the right people in front of the credit ratings agencies when they are on missions. I think this is maybe something that looks very sort of banal, but I guess that has not been always done across the continent. That is important. One final thought that we very much, or key takeaways that we had from this discussion, is the importance of facilitating this type of multi-stakeholder engagement with all actors, not only credit rating agencies and government officials, but also any other the investors. I think that would be also a lesson for us for next time to make sure that they are all part of this. One final thing, thank you very much to everyone. Thank you to the partners who very much made this happen. Thank you also to all the panelists that took part in this conversation. And last but not least, thank you to the audience and that are here in person, but also those that join us virtually. We very much thank you, and I wish you a very good week and productive week during the spring meetings here. Thank you very much again.